Leslie, the floor is yours. Let's see what you've got.
All right, great. So we've got an interior design focused moving company in San Antonio. This is not something I was searching for. This found me. So here we are. Look at a moving company. So a little about me. I'm a seasoned IT professional, passionate for helping others. This moving opportunity showed up. It's a niche moving company. They focus on interior designers. There's an established business in Houston, and this is a branch office in San Antonio. The owner is looking to sell. We'll talk a little more about that. San Antonio has a lot of military. There's a lot of other options, assisted living moving, and I've got a data center background as well. So that kind of ties right in with you there, John. That's why I was asking about smart hands. So the goal here to get this thing, build it up, and then grow it to a $10 million EBITDA with bolt-ons, et cetera, and then sell it off in 5 years and go on to the next thing. So this particular moving company focuses with interior designers. They have a warehouse, so they receive stuff, they put it up on shelves, they've got a forklift, and so they're basically storing it, and then they are taking it, white glove treatment, delivering that to the location for the interior designers. So fewer customers overall, not really much of a storefront from that perspective. Furniture storage, they've got good relationships with the local furniture dealers. If something gets delivered damaged, then they'll work with that so they don't have to, so they can get that all done before the interior designers get the equipment. And they're specialized in, moving pianos and antiques and all kinds of stuff like that. They've done several moves, and they mentioned they actually moved the estate of President Bush, former President Bush, at some point as well. So they've done a lot of cool things. We've got a marketing strategy to drive this to 4 million in 2 years. So the focus here would be to take what we have with interior design. The current owner is going to stay in the business and keep that piece going. And then we're going to focus on in-town moves. Again, we're like 15 minutes from, Lackland Air Force Base. And there's some, quite a bit of military in and around San Antonio. So there's a lot of movement, a lot of growth in that area. He's got very little digital outreach because right now it's mainly just, he's got the sign on the truck, he's got a website, but it's really just a form that brings it in to, have a call and go from there. But we want to grow this, and we've got a plan that takes into consideration the cost of the truck, the hours, the move, and all those costs, and then cost per customer as part of that process. So this is a creative deal structure. Basically the entry cost to get in is the cost of the truck and the forklift to get in.
Morning, Captain Lewis.
And then everything else is pulled out from the business itself. This branch has been in operation for 3.25 years. Last year they hit revenues of 533 with 125K SDE, and we're looking to accelerate relationships. So the current owner is staying on board. We had a nice talk yesterday. Had several conversations with him. He's looking to grow and build this. He's of the age, he's tired of driving back and forth. He's got his 22-year business there in Houston, and he's looking to bring somebody in that can actually accelerate this because he's splitting time between locations. Recently he had a knee surgery, I believe, and so he's also, a little bit hobbling around as well. So that's making it more of a challenge for him. So he's in for 10%, looking to help us grow and be part of that exit strategy as well. He has systems in place. He's working with interior designers. He's got scheduling. He's got phone support. He's got admin support with accounting. He's got a third party that will do the staffing for him and guarantee those folks to do all the vetting. So we're not having to have folks to do that. Part of this team we have includes an accounting, marketing, and the Dealmaker that actually brought it to me, not part of our group. But all the things we talked about were very in line with what you teach, Carl. So it was very, very cool to make that connection.
Okay.
So each of those are in for 5% equity as part of it, and then we're going to be taking it and growing from there. They had the marketing plan already in place, what was presented to me, as well as the deal structure. So this is the deal structure. The 260K is the asking price. It's 180 plus cash in the bank plus 80% of the AR, with 50,000 at close. And then we're going to build up business credit as part of this process, pay a $70,000 on a zero interest for 12 months. Then following that, we'll start a zero interest 24 months for the 140 after that. So that gets us into the deal with 50K for 125K SDE moving company. And what I'm seeking is 150 investment. So with the 150 investment, that will get us into the company. That will give us some marketing pieces, closing cost, and also some cost for general management, so we can get this thing up and running and really focus on growing the business through the marketing strategy. Looking at a 15% equity, and then a clawback after we pay back with interest on a 3-year balloon. Claw that back to 3% with an estimated value at 365 at the end as well. So cash on cash return at 2.44, internal rate of return at 19.49, based off of the numbers we projected. So looking at the deal itself, this is just kind of look at the forecast, and we will jump into this from the spreadsheet, but kind of showing you what we have in 2021, 22, and 23. Some potential estimates for 24. We're down to the last 4 months. So that is taking the marketing plan they put in place with the scaled up marketing spend to achieve those numbers. So a little bit dip on the free cash flow because we're spending that money in marketing. And then a significant piece going from there. You'll see it's quite a growth in 2025. And just to make sure this is even reasonable, I put in the number of customers based off of an acquisition of $500 per customer. We think it'll be less than that, but that's what we're using as our guide here. So 727 customers, not including the interior design folks we already have. That's separate from this. This is just the in-town move side. And then looking at the financials, here's the asking price. Here's what we're seeing. With his salary, he mainly gets paid out of the Houston office. So this is more of a token salary coming out of this branch. He started in November 2020, bought the truck and all those kind of things. So those aren't actually showing up on here because they were fully depreciated that first year. And you can see that it has built up, ramped up, and he needs somebody else to take the reins and drive it forward. All right. From there, I will go into the one sheet. Questions, comments so far?
Yeah, so a couple of things from me. So just so I understand this business model correct. So what these guys do is they work with interior designers. So an interior designer picks a project, and they basically, the interior designer goes and buys all the stuff. They store it in a central location, and then when they're ready, the stuff's moved out and put into the house. I'm just trying to understand what the need for this business is. Why wouldn't the designer just order the stuff directly from the manufacturer or the store and have it delivered directly to the property? Why does it need to go into a separate location? That's what I'm struggling to understand.
Yep, and I get that. So it's giving them the white glove treatment is what it really is, because they're handling it all. They're doing it all the way to delivery and setup. The designer's just there to say this goes here, this goes here, after they've, as part of that process. So it's more of a white glove, professional treatment in that respect. So, and the other thing is, I think part of this is on our call yesterday, I talked to the seller. He's also doing some stuff he's got a customer that's multifamily. They're building out an apartment complex.
Right.
They're actually using him to house the equipment. So they've got flat boxes of cabinets and whatever furniture, and he's storing it for them. So that way, when they're ready, they've delivered. He actually delivered. He said the lobby, they started setting it all up and said, no, we're not ready. So I had to take it back. So he's going to deliver it again. So it gives them a time element. It's available now. right? Versus waiting for that delivery or damage and stuff like that. It can all be,
Yeah, got it. I understand it now.
it's
Yeah. So
convenient, really.
yeah, I understand it now. Okay, cool. So like one of the cool things about this business is you're dealing with a very high-end section of the market.
Mhm.
And I love the fact that there's VIP clients on the one side, and then you've got more, multi-family, more volume clients on the other. So I really like that. My biggest issue with this deal, though, Leslie, is I don't think it's worth anywhere near what the guy's asking. This thing's been losing money. It's just gone into profit this year. I think $260,000 or whatever the ask is, even though you've put an annuity deal together, I think it's too much. And with so little cash flow already coming through this business, by the time you factor in an annuity payment and the cost of the people that you're going to want to come in and do it, I just think it's a bit too small. And then on the valuation side, you mentioned you're buying it for 260 in a creative way, but you're selling equity at $1 million valuation. So you've got an instant 4x bump on what you're valuing the business at, which I understand because you've got some pretty huge growth kind of forecasts in there. I think to even have a chance of raising capital for this, you're going to have so much substance and depth and rigor in those forecasts and exactly how you're going to do it, right? And all the metrics that you're going to have to do. And you know how to do that, right? So I would definitely do that. But like for me, I think this is an earn-out deal. Personally, I would literally I'd be offering him $1 down on this deal. I'd raise a small amount of equity capital to get you started, and I think for me, I'll let Jeremy chime in, but yeah, I wouldn't pay 260 on this for an annuity deal because I don't think you're going to have the cash flow, unfortunately, coming out of this business to sustain it. But it's a really interesting business, really unique. I have no doubt you can blow this up to the moon. It's just a shame it's so small,
Right.
and I think the amount of equity you'd need to raise, to set you up for huge success. I think investors are really going to struggle with that $1 million valuation unless you've really, really, really got some rigor around, how you're actually going to do it. So I'll let Jeremy chime in, then we'll go to David Gerald. Jeremy,
Awesome.
what do you
Thanks,
think?
Carl.
Yeah, I was thinking the same thing. I very little cash down, if anything. Maybe a little bit of skin in the game, but I think the balance of it has to be some sort of annuity, basically, where you're just splitting profits at a certain agreed upon percentage over a period of time, and set the price at until that person actually gets paid back that amount. So yeah, I just think any business that has a loss of 2 years, and now they're just getting the profits. I mean, what I would look at is, it's almost kind of a startup situation. What would it cost you to just go out and start a business similar to yourself and go lease a
Yeah.
truck in a warehouse and just start it on your own versus paying the person $300,000 to do it. So that's kind of how I'd look at it.
Yeah, one of my other ideas, Leslie, is I think this deal might fit more as a consulting for equity deal. Maybe you can sell the guy on your vision and your growth and what you're going to do. Let him have you half, give him half. He gives you half of the business, and then you have an option to buy him out for the 260 at some point in the future. It's like a mini Alan Bronson deal, this, right? It's like the value he's placing on the business, it's not worth that. And you're the one that's actually going to have to create that value in the future, right? So all that risks on you. So I would do this as a consulting for equity deal, personally. I think if you can really like blow this thing up revenue wise as per the forecast, and he just doesn't have the chops or the energy or the vision to do it himself. That's how I would do it, and then sell him on, say, hey, we'll buy you out for the full 260, within say the next 2 years. If you get anywhere near those forecasts, you'll have so much cash flow you could fund the deal, just from that. So That's what I would do. I think they're really hard to raise that kind of equity to do that deal, and I just don't think there's enough cash flow coming out of it to kind of pay everybody.
So what do you see just from what we have as far as raising the equity right now? What kind of number do you think that would work?
Um, I don't know, man. I think it's going to be really tough. I think it depends on the deal structure. I think if you can do a consulting for equity deal, and then maybe get $50,000 or something like that for somebody to come in and just partner with you, and really have a punt. I just think the $1 million valuation you set for the equity raise, that's all based on the future valuation. So yeah, if I'm understanding it correctly, yeah, I think that's going to be a tough ask. I think a consulting for equity deal is the way to go on this. That's what I would suggest. But let's go to David Girolt, and then Ayaz has got a question. We missed him last time, so we'll go to him next. David?
Yeah, I struggle when we're looking at businesses that are below, certainly below $100,000 in adjusted EBITDA, but really below 200,000, 300,000 in adjusted EBITDA. There's just not a lot of meat on the bone. You don't have you don't have the cash flow to invest in growth. You're looking to you're looking for the equity to fund the growth plan, because the business doesn't throw off enough cash flow to fund its own growth yet at this point.
Right.
So I'd rather see something that's more established, that you're really buying a foundation, because the reality is here, you're really buying a startup. That's got a little bit of traction that you need to build on, but it still needs that startup type capital structure, because you're still going to be cash flow negative or burning cash in order to invest in the marketing to try to scale it. And then the other question, I think Chris answered it. My other question is how scalable is this? At some point, more trucks, and those aren't cheap. More warehouse space, and that, depending on where you're at, isn't cheap. So, in looking at that scaling, at what point, I think you're going to hit realistic. You're going to have kind of fits and starts in your growth trajectory. It's not going to be a straight line, because you're going to have some significant CapEx for warehouse space, for equipment and things like that. And you're going to have to buy that capacity out ahead of the growth, or else you're going to cap out.
So part of that strategy is focus on in-town moves, so you don't have the storage
Right.
challenge. And then the man hours and the trucks and the mileage and the fuel, all that was kind of taken consideration into that. And a $3,500 move, less all those pieces, and a $500 cost of customer acquisition on marketing would net us $1,500.
Yeah. So what is the average ticket right now on this business? What is the average move?
I don't have that, because they're not really focused on in-town moves.
Yeah.
So and I checked with Chat GPT, just kind of running through, hey, this scenario, that scenario, and that seemed to range probably more like 2,500 to 3,500, somewhere in that range. But the 3,500 is like packing material, all that, not just showing up, grabbing some boxes and taking them somewhere else. That would be a lesser expensive move. So, so it seemed that 3,500 seems fairly reasonable. I talked to my buddy over the holiday weekend, and he thought it was high, but he realized he spent like $2,500 for the people in the truck. He spent $1,000 to have somebody else pack the material, and then he spent another, I don't know, $700-800 on packing stuff, whatever. So, so he ended up, I think, with like 4,200 with his move, is what it ended up being. So, I'm kind of taking on that. So it's just hard to tell.
Yeah, but I mean, taking maybe say 2,500 for an average in-town move. I know, like my daughter's 2-bedroom apartment a couple of years ago, I want to say it was, $1,500 or so for an in-town move. You're basically, you're looking at tying up the truck for the day. So that truck can produce one move a day doing in town. So if you're moving 5 days a week, 52 weeks a year, if you had 100% utilization, that truck can produce $650,000 of revenue. And that's it. I mean, that truck never produces more revenue than unless you can get into, somehow get a value add to it. So that would be my concern, is just, how really understanding that model of how it scales and when you need to add, how long do you rent a truck before you buy a truck, et cetera.
Yeah.
David?
Had that factored in there as well, the truck rental. So, yes.
Okie dokie. Let's go to the questions. Look, we got Ayaz, and then I think Mark had a question. So we'll spend 5 minutes on that, and then we'll go to deal number 3. So Ayaz, the floor is yours.
More of a comment. So Leslie, just to consider, I've been looking at a deal that's in the appliance delivery and installation space. So basically what you guys are building is so when you think about growth strategies and bottlenecks and growth, so if you have a delivery infrastructure in place around trucks and people, this gentleman has contracts with like a lot of big box stores around appliance deliveries and installations, and he's doing about $6 million a year. His bottlenecks are getting people. So the bigger contracts you get, the more people he needs for the work. So that's a bottleneck for him. But that's certainly an area where he's gotten a lot of traction and built up a pretty good business. So something to consider. And then this is funny anecdote. I have a friend of mine who's an interior designer, and she specializes in moving divorced men who have never lived alone into their apartments after divorce. So she basically helps them move and set up in new apartments. So maybe it's a market you should consider.
Awesome. Cool. Did Mark, did you have a question? I saw Mark's hand up earlier.
Yeah, it was more really as an observation. You certainly seem to be passionate about the potential for this deal, but maybe I could just lodge a thought in your mind and ask you, this is a smaller deal, and it is restrictive on cash flow for investment and other things for sure. And I agree with everything everyone else has said. Would you get there? I look at it and think of it as like climbing a ladder, and this deal is towards the bottom of the ladder, and you got a lot of runs to go up as you start to grow that business over the coming years. Perhaps you'd get there faster if you found a business that you were also passionate about that was 6 runs further up the ladder with more cash flow, like at least $500,000 in cash flow or something like that. It's an easier deal to do, believe it or not. It just gives you more options going forward to grow it, and gives you a bit more of a safety net if things don't go quite your way. So I'm not saying yay or no, yay or nay to this one. I just wanted to offer that parallel track to say, is the juice going to be worth the squeeze for you compared to other bigger businesses, more profitable businesses that you might be able to buy? That was all.
Yeah, Mark, I think you've absolutely nailed it, right? That's my overarching thing here, Leslie. You're such a smart guy, and the pitch you put together and the passion you've got for this deal, like, you should be focused on, stuff at least $500,000 of EBITDA. And then, imagine buying a $500,000 version of this, or even just a removals company or storage company where you can quickly add this service in with the customers that you've already acquired. There's some truth to what Jeremy said about that. I agree with him. I wouldn't buy this. I think you can set one up, but then obviously you're not going to have a customer base, which I think with your marketing chops, you could quickly build. But imagine buying a storage or a warehousing company or a transport company, and then, plugging this in. The only other idea I had for you on the equity side, even though I think this is too small of a deal, like a transportation company that would get a lot of the, follow-on revenue as well as you scaled and outsourced that, they might become a potential investor, but then you're running the risk of them, turning around and just buying it underneath you. So.
Which outlines, Carl, exactly where this deal, kind of naturally seems to fit in your mind and mine as well. This is a good business to buy as a bolt-on. Yeah. It's not necessarily the business that you want to buy as a platform, because you've got no leverage to do anything else. You're going to be dragged into it as an operator to do a lot of the work, which you might be planning on, to be fair. If that's where you want to go, then that's cool. But while you're doing that, you can't find other things to bolt on the side of it. So I don't think necessarily at the price that's being asked that it sells anytime soon. So I won't be surprised to find it in 15 months. It's still available for you, unless there's other circumstances driving it. but that would allow you to go and find a better platform business and then come back and bolt this on the side, because the cash flow from a $500,000 EBITDA business would pay for this quick.
Yeah,
Maybe
no,
just an idea.
Yeah, no, you're absolutely right, Mark. So Leslie, do the annuity deal challenge in Protege this quarter. Go and buy a transportation company or a big storage facility or a warehousing company. Go do one of those deals on an annuity deal basis, then just bolt this on. That's what I would do. Like, yeah, I think that this is too small of a deal for the first deal in this space, but you know, would be an interesting bolt on for sure. If that doesn't work,
So
you know, do a consulting.
my personal challenge is I've been focused on this, and I'm to the point where I'm out of runway and I've got to get a job or some sort of income.
Yeah, but
I've really enjoyed this, and that's why I'm trying to figure out a way. And this one,
Go and do Leslie, go do an annuity deal within the next 2 to
Yeah.
3 weeks. That will give you cash flow, and then you can bolt this on and then execute on the scale. Like you are 1 trillion% capable of going and doing an annuity deal. Like, you're so smart at this stuff and putting these things together. Like, it's just a little bit of deal origination. Go follow the exact annuity deal challenge framework that I put out on Monday. You will crush it. Go buy a company that you can then bolt this into. That's what I would do.
Awesome. Appreciate it, guys. Thanks for
or if you're at the point where you have to go get a job, go and also, as a parallel strategy to Carl's, go and look at some consulting for equity things that you could do in a broadly similar space where you can get some cash flow coming in each month to stop you having to go W2, or at least you could do W2 part-time, because it still gives you time to focus on what you're passionate about. But do not do this deal because of your pending W2, because that's deal hate, and you will regret that to your dying day if it's not the right business, without a doubt. That I'll be very firm on, I would say.
Very fair.
Hope that's not too aggressive from a Brit.
No, love it. That's what I'm here for. Appreciate all the feedback, guys.
Okay, thank you very much, Leslie. But great presentation, like absolutely amazing.